If I had to become profitable trading again, but I only had 90 days, here's how I'd do it. I'm Manir, also known as Ghostalk Trades on Twitter. Now, for some context, to become profitable in trading typically takes over 2 years. This is simply a thought experiment leveraging Parkinson's law that work expands to fill the time allotted. This will focus on long-term growth rather than high-risk returns, and here's exactly how it start again from zero. Now, I think that context is really important. A lot of the time, if you see these sort of videos, people can suggest the idea of flipping accounts, meaning that you deposit maybe $1,000, $2,000, and you take excess leverage to try and, see if you can grow that account further. But a lot of that time, you'll simply just blow up the account. So I wanted to make a video out there for people that are more thinking long term and actually for more of a sustainable trading career. Now, number one is capital. Depending on your starting capital, I would focus on taking advantage of leverage, such as in futures or in crypto. Now, before you say, hey, didn't you just say let's not take leverage? But this is to allow us to take multiple positions, even with a smaller account. So that doesn't necessarily mean we're taking 10x leverage and risking the whole account on a single trade. It's more so that it allows us to diversify, not so much to over risk. But what exactly would be the strategy? Well, I'd go for something that's not exactly fancy. Instead of trying overly complex approaches, I would build the portfolio to focus on basic risk premiums. Simply put, I would take risks other investors want to avoid. Now, what is a risk premium? Well, a risk premium is the investment return an asset is expected to yield in excess of the risk-free rate of return. And an asset premium is in form of compensation normally for investors, and it represents payment to investors for tolerating the extra risk in a given market over that of a risk-free asset. Now, it's not exactly like you're being given a percentage from the stock market. It's more figuratively that, you're getting excess return here because other people are not wanting to take on that risk. So a very easy example of this is simply trend following strategies. You could apply a trend following strategy into futures, maybe even crypto as well. And this could be with a combination of different entry signals, such as moving averages, ADX, on-chain channels, and all of these can be used to generate an entry and exit point for a successful trend following approach. Now, if you've never worked with trend following before, I'm pretty sure I've done a previous video around trend following. However, I will give you a short explanation of what trend following is. Realistically, we're just trying to take advantage of long-term trends, and this is normally going to be applied around very simple principles such as moving averages. So a very easy idea would be either a moving average crossover. So when a short-term moving average and a long-term moving average cross, then you're taking an entry, or it could be when price is crossing above that moving average. So let's say price crosses above the 200 moving average, and then you're taking a long position as it's gone above it. Now, why do I say to keep things simple? Well, let's hear why from Jerry Parker, one of the most successful turtle traders out there.
And looking at, once again, this one entry, one exit, and a stop loss, I think it's just going to stay out of a lot of trouble the fewer optimizations you have, the fewer parameters. You're not trying to fine tune things too much, but just have a sort of a crude way of staying in these trends. And my gosh, the last 6 months have just been so amazing. We finally all got reminded as to what really makes trend following. What makes it is these markets. They just take off, they go crazy, and your job is just not to screw it up. And first of all, do the trade. Most important thing ever is buy those breakouts.
Now, free is backtesting. The next step would be setting up a rigorous backtesting environment that makes sure we include transaction cost, slippage, and we test on out of sample data. We use years of data, so we have a large sample size, and we also test for parameter sensitivity. This would help filter out ideas that look great on paper, but fail when they're actually on the live market. Now, here's just an attached image of what a strategy can look like when you're just doing without fees. So that would be gross and then net of transaction costs. And you can see what a stark difference that really is in actual profitability, especially when a particular portfolio has a lot of rebalancing or when a particular strategy has a lot of signals. So you're going to be racking up a lot of those transaction costs. Now, if you are interested in learning more about backtesting and actually gaining the skill of it, I'll leave a link to a free starter kit in the top of the description for the backtesting bootcamp. Now, 4 is on execution quality. Execution leakage can destroy an otherwise profitable strategy. I'd prioritize to automate as much as possible, whether it be at first just my stop loss and take profit, so using like range orders, and then going on to full automation.
Fundamental problem, which is that I'm extremely lazy. I have no interest in spending my whole day babysitting a trading strategy and making sure it works properly. So my solution to that is automation, and my trading strategies are pretty much fully automated.
Then number 5 would be to expand. This lays a solid foundation to build up my capital over time. While it isn't a 100x return approach, it is sustainable and allows for consistent capital addition. There are faster ways to grow, don't get me wrong, but they come with excessive risk that most of the time when people are advertising them to you, they don't really tell you about. Additionally, if you do go after the path of taking on excessive risk, and let's say you do get lucky, you're one of those samples that actually, grows their account by 10x, let's say, you will then not have the principles of how you'd actually grow that account from there. Because how you grow, a 10x size account to consistently grow is not the way you have done it to grow your $1,000, $2,000 account with excess risk. If you do that, at some point you will just blow up the whole account, because over a long enough sample size, you aren't really having an edge if you're taking on that much excessive risk. Now, this is just my opinion of how I'd start over in a more sustainable way. It's something I actually really wish I knew when I was starting out over 5 years ago. But feel free to let me know how you would do it. Feel free to put a comment of what sort of ideas you would do if you were starting over. Now, if you found this type of content valuable and you want more every single week, feel free to follow me on Twitter at GhostHawkTrades, or feel free to subscribe. I'll upload at least 1 to 2 videos every week. Have a great day.